Insurance is defensive planning when it comes to a financial plan. The late great Bear Bryant said that offense sells tickets, but defense wins championships. Welcome back to Invested in You, brought to you by Community First Investment Group. We're here to help you take your next step in your financial journey, no matter where you're starting from. I'm your host, Nate Hasto, and in the last episode, we cleared up some investment rumors that we often hear. Today, we're covering an important piece of your financial puzzle: insurance. I know it's everyone's favorite part of the financial puzzle as well. We'll talk about different types of insurance, like life insurance, disability insurance, long term care, and more importantly, how it fits into your overall financial strategy. So let's start with the basics. Why is insurance crucial as a part of a financial plan? And I think ultimately it's important to understand what is insurance at large first. At its core, insurance is a transfer of risk. It is you handing an insurance company a monthly premium, an annual premium, however you decide to pay. And in exchange, they will take some of the risk off of your plate and you will give them some money to do so. Um, Insurance is a protection for the what ifs in life. It helps prevent financial plans from unraveling due to unexpected expenses. Um, Events that are out of your control are a big thing that really comes to play here. Good insurance supports long term financial security and peace of mind. There are several different types of insurance, and we're certainly not going to cover every possible option today, but I do want to cover some of the main ones that people will see on a day to day basis, and that many of these we do some level of advising for as well. So, the first type of insurance that we'll break down is probably one of the most common that we discuss with people, and everyone's favorite to do shopping for. It's life insurance. Now, the reason that life insurance matters at all is because we don't know if you're going to make it across that finish line. Now, we hope that every single person that we work with to establish a policy does, and it's one of the only insurances you purchase, and I guess truly hope I never need to use any of this. But it's a important one regardless. The reason it matters at all is we don't have typically a large pile of money to begin with, especially early on in our career as we're getting jobs and buying homes and starting families. We're certainly not at a spot where we have our full nest egg developed at that point. So, what life insurance does is it sets aside a large pile of money in case you aren't able to spend several decades earning and saving for the future. That's there to protect dependents. It's there to cover debts. Mortgages are a pretty common one for people to consider. It can be a part of an estate planning strategy. It can be considered income replacement, but it's there in the case of a catastrophic loss, in the event where a breadwinner or just a parent in general loses their life, and it provides some financial support for a family. Now, it doesn't need to be multiple millions of dollars. The goal is not necessarily to be worth more dead than alive. But there are calculations we use as financial advisors to help people understand what is the right amount, what type of life insurance can they purchase, and how does it align properly with their plan. And in the beginning, it is certainly there as income replacement to ensure that the family is stable financially in the event that one of the breadwinners or parents is lost. The second, and probably the most overlooked in a financial planning strategy for many people, is disability insurance. This protects your income if you're unable to go to work due to illness or injury. Now, there are different types of disability insurance. You have short term and long term disability, but we're just going to talk about these in generalities a little bit today. If you consider the odds of passing away prematurely, aka life insurance, or being disabled at some point in your working career, disability insurance, it's actually more statistically probable that you'll end up disabled than pass away early. Now, one disability could be catastrophic. You may be in a position where you never recover and you can never go back to work, but that's not typical of a standard disability. Life insurance, if you pass away, there is no coming back from that. So that's a catastrophic loss. That's something that, even though the odds are lower, it could potentially be a larger impact to a family and a financial plan. But disability is important nonetheless. If we consider that for your average 20-year-olds, 1 out of 4 will become disabled at some point during the career by the time they're 67. Um, 95% of disabilities are not covered under workers' comp insurance. There's a big gap that exists for people. Their ability to earn income is the fuel that runs the engine of their financial plan. And not only their financial plan for getting ahead, but just their day to day life. There is a direct correlation between you continuing to earn income and you being able to stay in your home. So, disability insurance is important nonetheless. What we typically guide here is you can own private disability insurance. Usually, an employer that offers a solid benefits package will have some sort of a disability insurance plan available through work. This can be extremely affordable, but it may not be enough to cover truly what you need. So, looking at how do I combine what I have available through work if I do have something, and what can I put in place in my own personal financial plan can be the right balance to consider, but that's something we'll look at for every single client that we serve. The third is health insurance. This is a cover of medical costs. Typically, this is not something that a financial advisor is going to go through and make recommendations on, but something we do look at is we want to consider what are your deductibles. If you are in a high deductible health insurance plan, does it make sense for you to consider something like an HSA or health savings account? When you look at what it would take to qualify for a health savings account, high deductible plan sounds like a broad statement. Just, sounds like, hey, does it cost a lot before I actually start to get protection from the insurance company? But there are specifics that would allow you to qualify here. So without getting too far into the weeds, if you're interested in utilizing a health savings account, your high deductible health insurance plan needs to have deductibles of no less than $1,700 as an individual or $8,500 as an individual. That's the range. If you have a high deductible plan that is a $10,000 deductible, technically you don't qualify for an HSA. And it's the same premise for a family plan as well. The minimum is $3,400 to be considered a high deductible plan, or $17,000 to be considered a high deductible plan for families. So if you're somewhere in that range, you probably do qualify to have an HSA. Now, it may not be the best choice, depending on your health conditions, to have a high deductible plan, but some employers don't actually give you an option. Every plan is a high deductible plan. So sometimes you have choices, sometimes you don't. Strategizing which way you may want to go is something a financial advisor can assist with, but many advisors are not going to look for health insurance plans for you. They'll just help you analyze what your options are. The fourth type here is homeowners or renters insurance. So for obvious reasons, if you don't own a home, you don't need homeowners insurance. And renters insurance is not required like homeowners insurance is, but it's a good idea if you have several $1,000s, tens of thousands of dollars potentially worth of furniture and electronics and personal goods in your apartment. It is probably still a good idea to have a renter's insurance policy. These just protect your possessions against loss or damage. So again, if you were in a position where there was a flood or a fire, those are very common things to wind up with. Would you be able to repurchase all of the items that are in there? And money does not replace sentimental or one-of-a-kind things, or even things that just don't have a lot of monetary value but have a lot of emotional value. But it can help you just kind of stay with your head above water. A common one that we get questions about all the time is long-term care insurance. This helps cover the cost of assisted living, nursing home care, in-home care. Typically later in life, it's not necessarily exclusive to that, but that's the most common period of life that people will find themselves in considering or interested in long-term care services. There are essentially three different types of insurance that would fall under that umbrella of long-term care, or ways to go about establishing long-term care insurance. One is the more traditional long-term care insurance policies. These really are designed like car insurance in the sense that you pay a monthly or an annual premium. If you don't get into an accident or you don't need long-term care, that money is gone. They don't send you a refund check because you didn't use the insurance. This type of insurance is most likely to be something worth considering in your 50s, usually mid to late 50s, but it depends on everyone's given situation. Um, you can also go through what's called a hybrid long term care policy. These are typically connected with things like permanent life insurance as a rider to that policy or an enhancement to that policy. And it allows you to use your death benefit that you've purchased initially as a typically tax preferred way to go about funding a long term care event. And lastly, there's something called asset based long term care. This allows you to consider taking a chunk of funds that you might have, typically outside of retirement accounts, and using those funds to get some sort of an enhancement from an insurance policy, typically, that's connected to those assets. So there's, simply put, three different ways you can go about looking at covering long-term care insurance, and everyone has their own preference. Auto insurance, kind of self-explanatory. Probably the biggest mistake that we see people make on the auto insurance front is either being underinsured, so they just found the cheapest auto insurance that was available out there to make sure they could check that box legally, but it really doesn't cover them in the case of any sort of serious accident. Or they just continue to keep the same insurance provider year after year after year, increase after increase after increase, and they never do any sort of shopping. Um, One of the easiest ways to avoid having to do a ton of legwork with shopping is to find a broker that you'd like and trust. That person can do a bunch of the shopping for you and just make sure that you remain competitive and you're well covered. Lastly, we have umbrella insurance. And this is not in case it gets a hole in it while you're out in a rainstorm, right? This is really extra coverage that fills in the gaps. So, as a for instance, umbrella insurance goes above and beyond things like homeowners or auto insurance policies. So, if your auto insurance policy has a limit of $500,000 per accident, for instance, and you manage to cause $750,000 of damage in that accident. The way that that would work typically without an umbrella insurance policy is your insurance provider for auto insurance would cover $500,000, and then they would send you a bill for the $250,000 that's owed over and above what you had coverage for. That's where an umbrella insurance policy can step in and say, hey, I've got an additional 500,000 or an additional million that fills in the gaps here in the event that there's a bigger event that occurs. So it's a good idea, especially if you're finding yourself in a spot where you have any level of significant assets that you've started to accumulate. This can certainly protect you from having to dip into those piles. And even if you don't have significant assets set aside yet, it can put you in a spot where you don't have to consider bankruptcy or anything like that, with needing to take out loans or things like that to cover a accident that occurred. Some major and common mistakes that we see when it comes to insurance planning. Number one is just forgetting to update policies after life changes. So things like marriages. Oftentimes people are planners and they have gotten insurance policies in place prior to getting married. Their spouse is likely not the beneficiary on that policy yet, so that's a important designation to make there. Having kids, oftentimes we see folks who will name their minor children as beneficiaries on their insurance policies. While technically you can do this, there's not a feature in the policy that will restrict you from doing so. If the children are minors in the circumstance where you do pass away, they can't legally receive those funds directly. So oftentimes this creates much more headache than people are even considering when they go about doing it. The intentions are good, the execution just does not work well. In the event of a divorce, I can't tell you how many times I've seen a ex-spouse as a beneficiary on a either newly single or newly remarried individual's policy. Normally that is not a fun thing to find, but it is much better to find prior to something happening than after the fact. When homes are purchased, that's a good time to do a review. Oftentimes, if someone's been renting up until that point and they've purchased a home, they may not have enough life insurance coverage to ensure that the house would be taken care of in the event that they passed. So those are all really common things that come up when we consider doing a review for life changes. Another common mistake is people often will focus exclusively on price and not enough on the features that the policy actually provides. Again, this is a transfer of risk. So what we want to make sure of is that we have a good understanding. If we're looking for the cheapest price, you're not going to get as many options later on in the policy as you would if you paid a little bit more to get some more features and benefits. Typically, I just talk with folks about this to consider the end of the policy. You want to begin with the end in mind. And by that, I mean not premature passing away, but what happens at the end of an insurance policy, if you're considering a term insurance policy, for instance, which usually is the direction people will go if they're thinking, I want the cheapest policy available. But not all term policies are created equal. And what can you do at the end of that term if you're hopefully happy and healthy and still with us? What are your options then? Some people decide, you know what, at the end of the term, I am not interested in having life insurance any longer. I lived 30 years. I lived 20 years. I'm good to go. That was an important period for me to be covered. I don't want it after that. Other times, people find themselves in a position where they've been paying for it for 20 or 30 years for obvious reasons. If you're 20 or 30 years older, we don't know when the expiration date is for anyone, but we do know that we aren't going to live forever. So many people kind of have that kind of sunk cost impression where you decide, well, I've been paying for it this long. Let's keep paying for it. Let's extend this. Let's do something else with it. And I'll get into some more details about why you might want to consider that in a minute. But many people are interested in extending it beyond the initial term period. Being underinsured or overinsured. Now, if I had to say that one's more risky than the other, certainly being underinsured is more risky than being overinsured. And in many cases, with younger clients that we work with, they may be a tad overinsured now in their 20s or even early 30s, but it's a policy that they'll likely grow into. So it allows them to not have to go back through the underwriting process to get approved for another policy later on in life. They just do it kind of in one go. Lastly, I have here buying the wrong type of insurance. Now, this is a little bit subjective, but I do think that many people are sold an insurance policy that maybe is more than they need or is not organized in the proper way to allow them to really sock away money and grow money for the future. I would say this is a more frequent scenario if you're only working with someone who specializes in insurance and does not do any sort of investing. Typically, if you're working with someone who's a full-blown financial advisor, they have access to a full plethora of resources and are looking at the bigger picture. So I would just say buyer beware if you're only working with an insurance individual on that side and they're suggesting that you're investing in life insurance as an alternative to doing traditional investing. It's not necessarily wrong, but you want to really understand the differences in types of products that you could purchase to solve that need. When we consider how insurance fits into a financial plan, I teased this a little bit earlier, but insurance is defensive planning when it comes to a financial plan. The late, great Bear Bryant said that offense sells tickets, but defense wins championships. And at the end of the day, it's one of the first things that we consider when we're looking at someone's financial situation, because we need to protect the foundation of what they have in order for us to consistently and comfortably and confidently move forward. So the defense aspect, while it may not be the most fun aspect of financial planning, it's important nonetheless. This insurance aspect should align well with goals like retirement planning and estate planning. In the beginning, it is a risk reduction play in a financial plan. But it can very easily transition into an estate and a wealth transfer play further on through a retirement plan or an investment plan. Oftentimes, if you find yourself in 50s, 60s, 70s, and we're talking about anything resembling life insurance, usually, if we've done a good job saving up until that point, it's not because it would be financially devastating if either of the spouses or breadwinners were to pass at that point. You have a lifetime's worth of savings that's been set aside for that until that point. But it does create a really, really efficient transfer of funds from one generation to another. Death benefits on life insurance policies are tax-free if they're received by qualified individuals. So this is a way that you can go about wealth transfer and considering insurance as an estate planning strategy instead of a risk transfer strategy. Insurance needs change across life cycles. So I kind of mentioned it earlier, but the concept of insurance planning, in the beginning, the risk is, what if I pass away too soon? Later on in life, the consideration is, what if I keep on living too long? What if I outlive my money? There are other aspects of insurance that we could talk about regarding insurance on investments. But at the end of the day, I'm not going to dive too deep into that in our 101 session. So lastly, we have just the importance of periodic insurance reviews. Again, this is something, if you're doing insurance through someone who's doing insurance only, maybe they are doing annual reviews with you. I won't say that's a super common thing that I see, but it is very common to at least do annual reviews with your investment advisor, your financial advisor. Insurance should be an aspect of that annual review, just to make sure, again, beneficiaries are aligned, it still meets the needs, you're not underinsured, there's not features that would make sense for your plan or strategy or would pair well with changes that have happened in your life over that last year. So it's an important thing to make sure that you do that review on a regular basis. Before we wrap up today, we do have a Q&A section from one of our listeners. The question today is, I'm currently 32 years old and I've heard a lot about long-term care insurance, but I don't know when it's best to begin planning for it. At what age should I consider it? Now, in a broad brush, I typically would say the best time to start thinking about it is now. So whether it's 32, 52, 62, wherever you're at right now, it's a good time to consider it. However, when we consider the traditional style of long-term care insurance, I would argue that 32 is certainly too early to consider something like that. Long-term care insurance, like almost every other type of insurance, will take into consideration pre-existing conditions. So if you're 32 and you're healthy, excellent. When you're healthy and don't feel like there's an immediate need for the insurance, it is absolutely the best time to be doing shopping for it. It becomes a major headache and may not even truly be an option as we start to age and acquire conditions along the way. What I would say is, for someone who's 32, considering something in the hybrid category that I mentioned of long-term care insurance could be the most feasible option to actually take action on now. Just as a refresher, what that means is it's a long-term care feature on some sort of a life insurance policy. And I'm speculating because I don't know all the details for our question today. But at 32, you probably don't have a full-blown nest egg set aside to use asset-based long-term care type insurance. Not to mention, that's probably not what I would make a suggestion for at this stage either. The traditional long-term care, you probably could get approved, but you'd just be paying that for far too long for the benefit to be tangible for you. So that third option, the hybrid long-term care solution, is probably the best one to consider if you're seriously worried about that at this point and want to just make sure that you are prepared. So great question today. To wrap up today, I want to thank everyone for joining us on this episode of Invested in You, brought to you by Community First Investment Group. Here for your now, here for your future. If you found this episode helpful, share it with a friend or a family member who you think it may benefit. Be sure to check us out on Facebook and LinkedIn, and if you'd like to receive some personalized advice or assistance, our team is ready to work with you anytime. Visit cfigadvisors.com to get started, and our next episode will be our recap of Season 1. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services are offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA SIPC. Insurance products are offered through LPL or its licensed affiliates. Community First Bank and Community First Investment Group are not registered as a broker-dealer or investment advisor. Registered representatives of LPL offer products and services using Community First Investment Group and may also be employees of Community First Bank. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of Community First Bank or Community First Investment Group. Securities and insurance offered through LPL or its affiliates are not FDIC insured by FDIC or any other government agency, not bank guaranteed, not bank deposits or obligations, may lose value. There is no assurance that techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investments involve risk, include possible loss of principal. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly.